Hey, everybody, welcome back to another episode of Cash Flow Positive. If you're new here, welcome, welcome, welcome. Enjoy new listeners. My name is Kenny Bedwell. I'm the host of this podcast. And today we're talking about the opportunity cost of buying today. Now, there's the old adage that you may have already heard. When was the best time to buy? The answer is yesterday. When's the second best time to buy? And the answer that you might hear from a realtor or from a lender is today. But truth be told, if you look at the overall, just the data of the ups and downs in the real estate market, truthfully, buying today gets you a better rate of return than waiting and buying at some point in the future. Because the lesson is nobody has a crystal ball. No one knows what the market's going to be like. And if you wait for the drop, it might be many, many years. And in fact, just historically, we haven't really had a massive drop, at least 10% across the entire market since the 2008 crisis. So if you're just waiting and waiting and waiting for the numbers to drop down, you're always going to be waiting. And so what I wanted to do in this episode today is underline the theme of like taking action today and why that's important. And we're going to talk about a few deals, look at some of the numbers as someone who, if someone would have bought today versus waited 6 months, and the difference in what's going on in the short-term rental market specifically. So let's dive in. Okay, so number one, the first thing I like to talk about, just going from the macro economics of the real estate market, is that there's a crash on average about once every 20 to 25 years. And when I say a crash, I'm going to define that as a drop in real estate prices across the entire market. So the entire market being the United States market. Okay. It's obviously just like we know with Airbnb markets, certain markets could be doing better than others and others could be worse. But this is the market on average. And a crash is something that it defines as 10% drop in prices or less. So ladies and gentlemen, even with the high interest rate environment we're in, that's been going on for the past 2 to 3 years, I guess 3 years now, we have not seen a market level drop of more than 10%. So there's not been a crash. And if you're waiting for the quote unquote crash based on those definitions, you're still waiting. so the reality is this, like the 20 to 25 year time span. I mean, if you think like the last time we legitimately had a crash, which was 2008, and give that a few, and that was really just a couple cycles in 2008. We're still, maybe 7 to 10 years off from theoretically another crash occurring. So buying today is actually, on par with the average, on par with, the historic trends overall. But we still get questions all the time. Okay, well, cool. I understand I need to buy this year. When should I buy and why should I take action now versus maybe waiting for interest rates to go down? I heard that, Goldman Sachs said the Fed is going to cut rates later on in the near future, in the next like 6 months. And I should just wait until there's better rates. I'm just going to wait for the rates to go down. And although that may or may not be true, at the end of the day, I talk about my crystal ball, which I have right next to me here. Nobody has a crystal ball. They can make projections, they can make forecasts, but things happen. There's the war with Iran going on right now. Like, how is that going to impact interest rates? Well, it's going to make things stay stable because there's a lot of, I say make things stay stable. That's not the correct terminology. It's not stable. It's basically the Fed and everything aren't going to make cuts because they don't know, there's a lot of uncertainty. So they're going to keep things where they're currently at. And they might even increase interest rates because the cost of war is expensive, right? And the US might have to print more dollars. So there's just so much uncertainty if you're trying to time the quote unquote market. Okay. Now, with short term rental investing, timing the market is not a great idea for two reasons. And reason number one is the amount of demand versus the number of actually good deals out there. A lot of people think that there's an infinite amount of good deals out there. It's just being like they're there, and maybe Kenny has a secret list, or some realtor has a list. But the reality is, like, that's just not the case. deal flow and deal inventory vary based on seasonality. It's very cyclical. So what right now I would argue, because it's starting to be spring, I don't need to argue it, it's just facts. There's more sellers than there are in the dead of winter time, during Christmas season, during, January, February. However, in late summer, early fall, there's also a lot of sellers too, especially in short-term rental space, as they've taken their peak profits and now they're exiting the market. So there's different times when there's good and bad. However, from a demand standpoint, a lot of people are buying short-term rentals. You got to think about when people buy short-term rentals, right? And most of them buy short-term rentals when at towards the end of the year to take advantage of the bonus depreciation. That's why most people are actively purchasing. Obviously, we want good returns, we want cash flow, and I'm not saying there's people who aren't buying for those things, but most people who are buying short-term rentals, investors today, are buying for tax savings along with the other benefits secondary. And so they tend to wait till the end of the year. So our client load that we take on almost doubles in the last quarter or last two quarters really of the year compared to the first two quarters. Like, let's say we take on 10 people in the first two quarters, there's probably 30 to 40 people in the last. It's not that exact ratio, and the numbers are a lot more than that. But that's how many more people are looking at the end of the year. And so for investors, especially in the short-term rental space, if we're trying not to time the market, if we're trying not to essentially like catch the dropping knife, in a sense where we're trying to get it at the handle, the reality is you're never going to nail it perfectly. And hindsight always tells us to take action right away if we have the means to be able to take action. I want you to think about that for a second. So I am a big believer in taking action today and not waiting. You can't time the market. I've learned that lesson the hard way. And I can't tell you how many times I kick myself in the where I'm like, man, I should have just bought more then, right? We all say that, especially with COVID. We're like, I should have borrowed more. I should have taken out more loans when interest rates were down in the 2s and 3s. It's like, why didn't I? Because we didn't know. We didn't know what to expect. We'd never seen something like that before. We didn't know how long it could last and what the aftermath would be from going from 2%, 3% interest rates all the way up to 7 to 8%. So timing the market is just a terrible idea. Just if you have the means to be able to take action today, then you need to take action. Okay. So what does that mean? Number one, taking action today means if you're planning to buy a property this year, now is the best time. Today is the best time to buy a property. Okay. The opportunity cost of you waiting. Okay. Not only is that the cash flow difference between the time you could have got started versus the time that you actually bought, okay, which is real. Think about it. If you let's sit on that one for a second because that's important. The longer and longer you wait to take action and to buy a property and to have it cash flow, think if a property's cash flowing, we'll call it $5,000 a month on average. Okay, 5,000, which is pretty good. That'd be a 60K payout at the end of the year. All right, most of us are shooting for that kind of range. So $60,000 a year, but $5,000 a month. Every month you wait to take action on buying a property, that's $5,000 that you're not getting. It's almost like you're paying $5,000. Okay. Now, for those of you who are saving money and you don't have enough money to yet buy a property that can net $5,000 a month, okay, then that actually doesn't apply to you. But for those of you who have the capital, it does. And what it means is you're actually paying because you're giving up that opportunity. It's called opportunity cost. You're giving up that opportunity of receiving that net cash flow. And in a sense, because you're giving that up, it's almost like you're paying that out of your own pocket. Think about that. You could be cash flowing $5,000 a month from action, but because of inaction, you're paying the $5,000 a month. Okay. We don't think of it like that psychologically because we're thinking, I've got my pot of gold or my pot of savings, call it pot of gold, my pot of savings here. And I'm waiting to take action. And, I obviously understand, inflation can, degrade the value of my money, but I don't physically see that. The money is in my bank account and that number doesn't change. And therefore, I'm fine. Right. But in reality, you could have been making more money on top of that by investing it, right? It's just the simple like laws of investing and compounding interest. Like it could be growing more and more, but instead it's not. And in a sense, it is actually shrinking in worth, in value. Okay. But we're too logical, or not logical, we're too like figurative. Like we look at an amount in our bank account and we go, I have $200,000 and I have $100,000 tomorrow. And until I spend it, it is there, it is safe, it is fine. Okay. But really, money, it's based on value of what it's the worth is deemed, right? So it's not about the physical number in the account, it's about what it's worth. And the worth of it is really just needing to get it put to work. We need to put it to work. And so if you're in a position to invest into a property, meaning you have the funds and the means to be able to do so, you're better served taking that action today than doing that 6 months from now, 4 months from now, right? Because that money is being able to be put to work, and it's increasing in value from appreciation from your tax savings. It's also a better bank account because you're paying down the debt on the property, which is giving you equity, more and more equity. And then obviously my favorite one, which is cash flow. The property is now yielding something back to you for it being used. What's crazy is people don't understand that banks, when you put your money in the banks, I mean, people know this, but they don't like comprehend it. They're loaning that money out. It's not physically there. It's just an electronic number that you see in your bank account. So they're loaning that money out. And yes, you can go and withdraw. I understand that. But there are situations and circumstances where banks have not been able to pay out, right? And that's why, we want to put our money in an FDIC approved bank, but some banks aren't. Okay, believe it or not. And people have lost money. And so it's not 100% risk free putting your money in a bank, especially if it's over $250,000. Then there's a lot of things to be questioned there. Obviously, it is very low risk, but my point being is if you have the means, if you're ready to take action, then take action. Go and do it. Do something because the opportunity cost of waiting is actually more expensive than just taking action today. Okay. So that's number one with the opportunity cost thing. Now, I kind of want to talk about like the tell of like two investors in two deals and how they took action and where they both are. So having worked with many investors before, I've seen the ones who were very eager and they've taken action. I've seen the ones who are a little more hesitant and they haven't taken action. And so I know two investors, one investor, and they both relatively make the same income and they both have the same savings and they both bought the same properties or had the, like budgets and everything. Okay. One was a little bit more eager and willing to take action, and the other one was a little more conservative and took their time and had inaction. They both still bought their first property and they were both really successful. Okay. Now we're in this example here, they both bought at the same time. Okay. Maybe one started before the other one, but we're not going to get here. Really, it came down to property number two. Property number two came along. Well, the first eager investor and the other one, they started at the same time, but the eager investor bought within 1 to 2 months. Okay. Now he did his renovations, he did his projects. So within 4 months after that, so 6 months total, he is up and going with property number two. Whereas the other investor, he still hasn't found anything. He's been looking for almost 8 to 9 months and still doesn't have a property to show for it. But investor number one, who did take action on that second property and was actually eager and willing to take a little bit more of the risk and put their money to work, he now has a cash flowing asset that's generating him over $8,000 a month. While investor number two has nothing at all to show for it and is still sitting on the same amount of money. Okay. Now, fast forward 6 months later, you do the math. Investor number one, $8,000 a month. That's $48,000 in 6 months. Investor number two is still sitting with the same pot of gold, hasn't done anything with it, and is out. So investor number one not only has built more wealth and tax savings and taken because of the action, he has $48,000 more than investor number two. Okay. Fast forward another 10 months. Investor number two is already on property number three, and the second investor is just now getting their second property. And so not only is investor number two, the first investor, the one, the eager investor, Mr. Eager Beaver, not only is he going to get a third property, he's about to lap investor number two. And not just lap him in sense of I have another property, but lap him in wealth building, lap him in tax savings, lap him in cash flow to where he's going to get to another level quicker and faster because he was willing to take action and put in the effort and the work to find something today rather than waiting or questioning things or waiting for the perfect moment. The problem is a lot of people look for the perfect property, but the best deals aren't perfect. They're all puzzles. Okay. I was explaining this to somebody the other day. It was a really interesting conversation. I was like, the best deals that I've ever seen are usually like really complex. They might be ugly looking, or they might be the seller might be in like a distressed condition or a distressed situation. I think of a Frankfurt property, for example. The guy had three mortgages on it. The seller had three mortgages on it. Like we had to negotiate with three banks, not him. He was just wanting to walk away so he wouldn't go bankrupt. But it was negotiating through three banks, meaning put in the offer. It would go through each bank. Each bank had to approve it to see how much they were going to get out of the deal before, he could just walk away. And so like that was a big piece of it. And just situation like that, like not a lot of people want to deal with that. A lot of offers would have just been like, nope, we can't do it. And so, yeah, I mean that those little things. The other property bought in Flagstaff, Arizona, we had to the seller was inherited the house from their grandmother who had just recently passed away. And, she didn't want to obviously didn't have the money or the means to be able to do any improvements to the property and needed it. And so it was like working with them and credits and trying to figure things out where it could make sense for both sides because it needed some things to it. And I see some of the best deals, other deals too. Maybe they're ugly, maybe in their, questionable zoned areas, meaning like, can we really STR it? Or I got to figure this out. There's a lot of different, like I was mentioning, like the best deals, there's just so much that has to be figured out in them that can make it really challenging for a normal investor just to go in and be like, yeah, that's a good deal. People will look at it and they'll pass it because it's not obvious, because it's not easy. Meaning they're not willing to put in the effort or the time to be able to figure out the deal. Sometimes the sellers are difficult to work with. And I totally get that. And then it becomes an emotional decision rather than a logical decision, which really it should be mainly logical. I understand in short-term rentals, there's some emotional component to it, but really the numbers tell the story and should let us, should help guide us make the decisions. And so overall, when I'm looking at different properties and when I'm seeing really good deals, they're typically complicated. They're puzzles. That's the best way to describe it. Like, it's like, we got to figure out all these things to see if this actually makes sense. If it does, man, this thing's in a good location. It has a great moat, or it's a really unique style of property, or man, the purchase price is really low. This is going to be great. But it's constantly a way. It's like, we've got to figure this out. And what happens for a lot of folks is they're like, I don't want to do that, or I don't want to spend the time doing that. Or that seems risky to me. Therefore, let me wait for something more obvious or something closer to home, or like whatever it is. And they justify waiting for the perfect thing that's going to come out for them. But the reality is that probably doesn't exist and won't exist. So if you're willing to be that eager investor that takes action, that really means you're willing to put in the work and the time to be able to figure out the best deals, because the best deals aren't obvious. They're the ones that require a little bit of work, a little bit of renovation, or a lot of renovation depending on the property, obviously, but they require someone to spend time seeing how you could do something. I think I'm almost all of the properties I've bought have been puzzle pieces, like puzzles. Watkins Glen, for example, when I was buying it, the city would not allow, they had a temporary ban on new short-term rentals, but they were passing, like they were going to do a lottery system for permitting. And I put in the contract, we would apply for a permit. If we got the permit as a short-term rental, I would close on the property. Nobody else did that. Okay. And that property had been sitting on the market forever. No one else was thinking about, like, can I go and do that? Like, contact an attorney and ask them, can I do this? The attorney said, yes, you can. Then I did it and I bought that property. I mean, it's an incredible deal. The best deals are the ones that you have to figure something out in, whether it's the renovation side or the zoning or the regulations or someone's weird financial situation of the seller. Like, it's all across the board. But the best opportunities are never super obvious. Okay. Now, these properties we buy, they have a moat. They have the things we've talked about on the podcast that help separate you from the competition, but there's something else behind them that makes them scare off a lot of investors. Those are, in my opinion, like when I see something scary, I'm like, you know, if I'm able to figure this out, I might have a really good opportunity here. It's probably worth my time to try to figure it out, right? We never want to force anything. We never want to make assumptions and go, well, this will be fine after I close. It's like, no, we want to shore up these things, whether it's, the zoning. I think regulations, for example, that's a pretty common one. People are like, oh, well, this property, it's in the city limits. It can't be STR'd. Cool. But it might be unique enough where, have you checked the zoning? Is it residential zoning? Could it be on commercial zoning? Like those little, just like checking that. If it's commercial, all of a sudden the game's changed, right? And the property is valued more in a sense where you can STR, you can do certain things with it. Now that's, area specific. But my point being is like, wherever the stop is on some properties that might look like an obvious good opportunity, wherever it's like, oh well, the insure we had, oh my gosh, actually this is a really good example. I make this mistake. There's a property in California that it's got an indoor pool, it's massive, and it's near a national park. It looks like it would be the perfect short-term rental. And it's really cheap too. And we're like, what? Why has no one bought this one? And it's because you have to get a special insurance because it's in a fire zone risk area, which is probably most of the state at this point, to be honest. But specifically this property. But we found most people you can't call Proper, you can't call Steadily, you can't call anyone, and they're going to insure it. They're not. You got to find someone local. And how did we figure that out? Somebody on our team spent the time to actually make the phone calls and figure out if it could be insurable. And it is, which is a major, like that was the deterrent for anyone buying that property, is because they were looking at it and they were making calls to see about the insurance and they weren't able to get it. Property go under contract, fall out of contract, and then it would just sit there and sat there. Now everyone thinks there's a problem with it besides just the insurance, but we know there's not. So just figuring out those little things, taking the time, if you're able to take that action, I'm telling you right now, you will scale so much faster and you'll be able to move. Don't rush projects. Don't rush decision making. Obviously, run the numbers, but taking action today is going to pay off a lot more than waiting for tomorrow. Okay. There's going to be more investors looking for tomorrow, and they're willing to take less of returns than you are. So you've got to take action and you've got to be smart today. So I hope you enjoyed this episode. I hope you felt like you took a few nuggets from it. I just want to just emphasize one little thing before I go. If you have the means to take action, it's more important to take action today than to wait for tomorrow and assume that the circumstances and the environment will be better tomorrow. So if you have the means, that's the key phrase, have the means. If you don't have the means, don't take action today. Wait until you do have the means. We don't want to rush into something. We don't want to make a mistake if we don't have the funds. So anyway, I hope you enjoyed this episode. I hope it gives you some confidence. I hope it gets you excited and pumped up to go out there and find some deals, because they do exist. Remember, they're just puzzles. They're just puzzles. You got to piece them together. All right, my name is Kenny Bedwell. I hope you enjoyed this episode of Cash Flow Positive, and I'll see you next week.